Hi guys. Today we will analyze Chevron stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock is a good performer in the overall market. The short term is neutral, but the long-term trend is still positive. Strong support levels are around $154 and $130. Next strong support levels are around $112 and $100. Resistance level is around $175. In the last month the stock has been trading between $151 and $175 range, which is wide. It is currently trading in the middle of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 10.5 million. This is a good sign as it is always nice to have a liquid stock. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model, discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 14% per year, for last 5 years. We see that the average profit margin of the stock has been around 5% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 149% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Chevron company: bad, average, and good. First scenario. Chevron will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be a low, -3%. Future profit margin would be a low, 4%. Future free cash flow to net income rate would be a low, 80%. In this case, the fair value of the stock today would be $56. Second scenario. Chevron will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 0%. Future profit margin would be average, 5%. Future free cash flow to net income rate would be average, 90%. In this case, the fair value of the stock today would be $78. Third scenario. Chevron will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 3%. Future profit margin would be high, 6%. Future free cash flow to net income rate would be high, 100%. In this case, the fair value of the stock today would be $107. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 10.64. Minimum rate of return. I will use 10%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Chevron, analysts forecast growth rate around -5% per year in next 5 years, and future P/E around 10. Again, I will use 3 different scenarios for Chevron company: bad, average, and good. First scenario. Chevron will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be a low, -3%. Future P/E would be a low, 12. In this case, the fair value of the stock today would be $41. Second scenario. Chevron will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 0%. Future P/E would be average, 14. In this case, The fair value of the stock today would be $63. Third scenario. Chevron will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 3%. Future PE would be high, 16. In this case, the fair value of the stock today would be $94. As you can see, today the stock is overvalued, $166, even if we expect the company's high performance in future. Chevron is one of the best oil companies, with an impressive portfolio of assets, but the revenue is expected to decrease by -5–10% on average over the next 5 years. This is bad. And the stock is currently too overpriced. I will buy the stock for the dividend, 3.4% yearly, when the stock drops to $100. Company's strengths. Chevron is an American multinational energy corporation. It's one of the largest companies in the world, and the second largest oil company in the U.S., behind ExxonMobil. The company's operations range from energy exploration and production, to refining and retail marketing. Chevron is one of these companies, as it benefits from best-in-class production growth, industry-low operating costs, and a strong balance sheet. Free cash flow growth is expected to accelerate beyond 2021, as capital spending remains capped, while Permian production could nearly double, and expansion at Tengiz, in Kazakhstan, adds volumes. The company is increasing its focus on clean energy, and expects to complete its purchase of Renewable Energy Group, a producer of renewable fuels, later this year. Chevron is a dividend aristocrat. It increased its dividend for 34 consecutive years. With a yearly dividend yield of 3.40%, the stock has a good dividend return. The company's return on assets of 6% is amongst the best of the industry. Its profit margin of 11.6% is comparable to the industry average of 11.2%. Risks. The company is exposed to volatile, cyclical, and capital-intensive segments of the energy sector. Investors in Chevron shares are exposed to numerous risks, including trends in energy prices, interest rates, and global economic growth. Chevron also operates in some countries with a history of official corruption, and in others that are prone to political upheavals, for example Nigeria and Venezuela. Greater adoption of electric vehicles in the U.S., specifically California, could reduce demand for refined products, impairing the value of Chevron's refineries. Environmental, social and governance-related risks include changes in policy related to climate change, such as a carbon tax that could result in higher costs, reduced demand, or stranded resources. Operating in offshore environments exposes Chevron to the risk of large oil spills, that could result in material losses through lost revenue, fines or penalties, or loss of license to operate. As a large chemical producer, whose products are key components of plastics, Chevron faces the risk, environmental concerns result in bans or usage reduction, that reduces demand for its products, or higher costs related to reuse or recycling. Chevron's return on equity of 11% is worse than the rest of the industry. The industry average return on equity is 14%. The revenue is expected to decrease by -5 to 10% on average over the next 5 years. Based on estimates for the next 5 years, Chevron will show a small growth in earnings per share. The EPS will grow by 3 to 5% on average per year. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.